AI looks set to become one of the most profound innovations and biggest investment opportunities in human history. But how can we quantify and ultimately capture its growth potential? In our new report on AI called Sizing and Seizing the Investment Opportunity, we break down the investable AI universe into a value chain, and we provide a framework for investors looking to put money to work in the sector. We can think of the AI value chain as three layers, which build on one another. The first is the enabling layer. These are the companies that provide the backbone for AI development, ranging from semiconductors to cloud and data centers and companies involved in power supply. Second, there's the intelligence layer, the companies turning computing and energy resources from the enabling layer into intelligence. That includes those companies developing large language models and companies that own data assets that can be turned into intelligence. The third part of the AI value chain is the application layer. Those companies that embed the tools from the intelligence layer into specific use cases. For now, we believe the most promising applications include copilots, coding assistants, digital advertising, and call centers. We also see potential in healthcare, R&D, cybersecurity, and fintech. We believe that thinking in terms of a value chain is crucial. Even in an industry that's growing fast, the fortunes of different parts of the value chain may vary because of rapid innovation, evolving competition, and shifts in investor sentiment. Value chain thinking can also help us understand potential opportunities and threats to the success of the overall industry. For example, eventually, the application layer will need to generate enough revenue to pay for the intelligence and enabling layers. So a key metric for future investment returns is likely to be the ratio of the application layer's monetization to the cost of the enabling and intelligence layers. The first key point in our view is to make sure you're sufficiently invested. Many investors have already built at least some exposure to the AI value chain. Yet the sheer pace of growth in the industry means many are still underallocated overall. Second, we recommend tilting investments toward the enabling layer of the value chain. Right now, we believe this segment offers the best mix of attractive and visible earnings growth, strong competitive positioning, and reasonable valuations. We like the semiconductor companies that are driving the investment in AI infrastructure at the data center and at the edge. Third, megacaps are core to the story. The AI rush so far has been highly beneficial for the largest tech firms. But we believe that's a feature of the AI investment landscape and not a bug. Ultimately, we expect an AI market that's dominated by a small group of vertically integrated companies. So alongside semis, we also like the oligopolies that are positioned across the tech stack, covering chips, cloud computing, generative AI models, and applications. Finally, remember, it's not only about the US. China's tech monoliths are still trading at similar valuations as they were before the launch of ChatGPT. Yet they're also investing heavily in AI, and eventually, we expect China to develop an AI ecosystem that's distinct from much of the world. We expect this will lead to strong monetization over time. The growth potential of AI is vast. We estimate that AI value creation could amount to close to $1.2 trillion by 2027. We believe now is the time for investors to size and seize the investment opportunity. To find out more, please reach out to your UBS representative. Thank you.